Do you know that the most aggressive trade war in American history since the Great Depression is happening right now? And that the historical record of every major tariff war in the last 100 years gives us a precise picture of what comes next? In April 2025, the United States government announced a package of tariffs more sweeping than anything implemented since the Smoot-Hawley Act of 1930. Tariffs of 145% on Chinese goods. Blanket 10% tariffs on imports from every country on Earth. Additional sector-specific tariffs on steel, aluminium, semiconductors, and automobiles. The scale was extraordinary. The speed was unprecedented. And the economic consequences are now unfolding in real time, with a trajectory that the historical record makes considerably more predictable than most people realize. This video is about what trade wars actually do. Not the political argument, not the ideology, not the promise of bringing manufacturing home or punishing unfair competitors. The data. What happens to prices? What happens to employment? What happens to supply chains? What happens to the countries that retaliate? And what the historical record, from Smoot-Hawley in 1930 to the steel tariffs of 2002 to the 2018 trade war with China, says about where the current situation is heading. This is for educational and informational purposes only and does not constitute financial advice. The basic logic of a tariff is simple. A tariff is a tax on imported goods, paid by the importing company and passed on to consumers. If the United States places a 45% tariff on Chinese-made televisions, then every television imported from China costs 45% more at the border. American importers either absorb that cost, reducing their margin, or pass it on to consumers as higher prices, usually some combination of both. The political argument for tariffs is equally simple. By making imported goods more expensive, you make domestically produced alternatives more competitive. American-made televisions, previously undersold by cheaper Chinese alternatives, can now compete on price. The domestic industry survives or grows. Jobs are created or preserved. The tariff in this story is a form of industrial policy, using the price mechanism to shift production back to the domestic economy. This logic is not entirely wrong. In specific sectors, under specific conditions, tariffs can provide meaningful protection that sustains domestic industry. The infant industry argument, that new industries need protection while they develop the scale and competitiveness to survive, has been used successfully in the economic histories of Japan, South Korea, and Taiwan. There are circumstances in which tariffs work. The question is not whether tariffs can ever work. The question is whether the specific tariffs being implemented now, of the scale and breadth being implemented, in the specific economic context of 2025, will produce the outcomes their proponents claim. And the historical record is considerably more pessimistic than the political argument suggests. Let us start with the most important historical precedent, because it is the one that the architects of modern trade wars most need to understand. The Smoot-Hawley Tariff Act of June 1930 did not cause the Great Depression. The Depression had already begun. The stock market had crashed in October 1929, and the banking system was beginning to buckle. But Smoot-Hawley turned a bad situation into a catastrophic one, and it did so through the exact mechanism that every trade war since has repeated. Smoot-Hawley raised tariffs on over 20,000 imported goods to historically high levels, an average rate of about 45%. The stated purpose was to protect American farmers and manufacturers from foreign competition during the economic downturn. The actual effect was immediate and devastating. Canada, which was America's largest trading partner, immediately raised tariffs on American goods. Britain established the imperial preference system, giving preferential trade terms to empire nations and effectively excluding American exports from a vast market. Germany, already struggling to pay its war reparations, saw its export markets collapse. France, Italy, and dozens of other countries raised their own barriers. Global trade, which had been declining since the crash, fell off a cliff. Between 1929 and 1934, the total value of global trade fell by 66%. Not 66% less growth, 66% less trade. 2/3 of the world's commerce simply stopped. For American farmers, the people Smoot-Hawley was supposed to help, the consequences were catastrophic. Export markets were closed by retaliatory tariffs. Domestic prices were supported briefly, then collapsed as the Depression deepened the deflationary pressure that no tariff could address. The farm crisis of the 1930s, the Dust Bowl, the foreclosures, the migration of hundreds of thousands of families westward was not caused by Smoot-Hawley alone. But Smoot-Hawley made it worse. 1,028 American economists signed a letter begging President Hoover not to sign the act. He signed it. And the lesson was clear enough that American trade policy for the following 70 years was built on an entirely different foundation. Multilateral trade agreements, the gradual reduction of barriers, the establishment of a rules-based international trading system. That foundation is now being dismantled. And understanding what Smoot-Hawley actually did is not optional for anyone trying to understand what the current trade war will do. The more recent historical precedent is the 2018 trade war with China under the Trump administration. This is the direct predecessor of the 2025 escalation. The same administration, the same logic, a different scale. In 2018 and 2019, the United States imposed tariffs on approximately $360 billion of Chinese goods. China retaliated with tariffs on $110 billion of American goods. The trade war was followed by a Phase 1 deal in January 2020, which committed China to purchasing $200 billion in additional American goods, a target that China did not come close to meeting. What did the 2018 trade war actually accomplish? This is the question that the rhetoric around the current escalation mostly avoids, because the honest answer is not flattering. American consumers paid more. Studies published by the Federal Reserve Bank of New York and the National Bureau of Economic Research estimated that the tariffs imposed in 2018 were costing American households approximately $800 per year by 2019. That cost was not distributed evenly. It fell disproportionately on households in the lowest income quintiles, who spend a higher proportion of their income on manufactured goods. American manufacturers in tariffed sectors paid more for inputs. The steel and aluminium tariffs that were imposed first raised the cost of those materials for every American manufacturer who used them, which is most manufacturing. Studies found that for every steelworker whose job was protected by the tariffs, roughly 8 jobs were lost downstream in industries that depended on cheap steel. The manufacturing jobs that the tariffs were supposed to bring back from China did not come back. Some production shifted out of China, but it went to Vietnam, Bangladesh, Mexico, and other low-cost producers, not to the American Midwest. The supply chains that had been built over 30 years did not reverse. They rerouted. The Phase 1 deal, the ostensible political victory of the 2018 trade war, did not significantly change China's trade practices. The intellectual property provisions that were the stated purpose of the tariffs were not enforced. China's bilateral trade surplus with the United States, which the tariffs were supposed to reduce, had actually increased by 2022. The 2018 trade war was not a success. The 2025 escalation is the same approach at 3 times the scale. The immediate economic consequences of the 2025 tariffs are now visible in the data. Inflation, which the Federal Reserve had spent years bringing back toward its 2% target after the post-pandemic surge, has re-accelerated. Categories of consumer goods subject to tariffs, electronics, clothing, household appliances, automobiles, have seen price increases that have been passed directly to consumers. The precise inflationary impact depends on the degree to which importers absorb versus pass on the cost, and on whether consumers shift to domestic alternatives. Where domestic alternatives do not exist, and in many categories they do not, the pass-through is almost complete. Supply chains built on global integration do not reconfigure in months. They reconfigure, if they reconfigure at all, over years and decades. In the short term, the disruption of established supply chains is simply disruptive. It raises costs, delays production, and introduces uncertainty that businesses manage by reducing investment. Capital expenditure plans that depended on stable import costs are revised downward or deferred. Hiring decisions are delayed. The retaliatory tariffs from China, the European Union, and Canada are compressing the earnings of American agricultural exporters, aerospace manufacturers, and technology companies. China, which is the largest market for American soybeans, has reduced purchases. The European Union has imposed tariffs on American bourbon, motorcycles, and agricultural goods. Canada, America's largest trading partner, has imposed dollar-for-dollar retaliatory measures. The political pain of retaliation falls on American exporters, who are organized, visible, and politically articulate. The political benefit of the tariffs, the protection of domestic manufacturing, falls on workers in sectors that are diffuse and often in regions that lack the same political voice. This asymmetry has historically been one of the mechanisms by which trade wars persist longer than the economics justify. There is a structural argument for the 2025 tariffs that deserves to be taken seriously, because it is not the same as the crude protectionism of Smoot-Hawley and deserves a more careful analysis. The argument goes like this: 30 years of free trade policy, beginning with NAFTA in 1994 and including China's accession to the World Trade Organization in 2001, produced a hollowing out of American manufacturing that damaged working-class communities, created strategic vulnerabilities in sectors like semiconductors and pharmaceuticals, and enriched the top decile of the income distribution while squeezing the middle. This is not an invented argument. The economic evidence for wage stagnation in manufacturing communities is real. The evidence for increased Chinese competition as a contributor to manufacturing job losses, the China shock literature associated with economists David Autor, David Dorn, and Gordon Hanson, is empirically solid. The strategic argument about semiconductor dependency on Taiwan and pharmaceutical dependency on Chinese API production is taken seriously by defense and intelligence establishments across the political spectrum. The question is not whether there are real problems with the trade regime that preceded 2025. There are. The question is whether broad tariffs of 145% are the right instrument for addressing those problems. And the historical evidence suggests they are not. The Inflation Reduction Act, the CHIPS Act, and other industrial policy legislation passed in 2022 and 2023 represented a more targeted approach. Direct subsidies for domestic manufacturing in strategic sectors, rather than broad tariffs that raise costs for everyone. The results of those policies are beginning to appear in investment data. New semiconductor fabs, new battery production facilities, new EV manufacturing plants. Tariffs, which raise costs across the board and trigger retaliation, are a blunter and less effective instrument than targeted industrial policy. The countries that have successfully rebuilt manufacturing, South Korea in the 1970s and 1980s, Japan in the post-war decades, China itself over the last 40 years, did so through a combination of targeted protection, deliberate industrial policy, export promotion, and currency management, not through broad tariffs imposed on all imports from all countries simultaneously. Let us talk about what tariffs do to the stock market, because this is often where the immediate pain is most visible and most personally relevant. Tariffs introduce uncertainty. Markets hate uncertainty more than they hate bad news. Bad news can be priced in. Uncertainty, the range of possible outcomes being very wide, makes pricing impossible and drives investors toward caution, cash, and lower risk assets. The announcements of major tariff increases in 2025 produced immediate and substantial stock market declines. The S&P 500 fell significantly in the days following the April 2025 tariff announcements. Technology stocks, which are most dependent on global supply chains and on sales in international markets, particularly China, fell hardest. This is consistent with what the 2018 experience showed. Tariff announcements in 2018 consistently produced stock market declines, with the affected sectors falling more than the broader market. Retaliatory announcements from China or other trading partners amplified those declines. The stock market volatility created by trade war uncertainty has real economic consequences beyond the headlines. Company investment decisions are made by executives who assess risk. When the range of possible tariff outcomes is wide and the direction of policy is unpredictable, the rational response is to delay major capital expenditure commitments. Delay capital expenditure long enough, and you delay hiring. Delay hiring long enough, and you delay the growth that tariffs were supposed to produce. There is also the direct effect on corporate earnings. Companies that import goods subject to tariffs have higher costs. Companies that export to countries that have imposed retaliatory tariffs have lower revenues. Both effects compress earnings. Compressed earnings produce lower stock prices, all else being equal. The longer a trade war lasts, the more the uncertainty persists, the more damage accumulates. The historical pattern from 2018 to 2019 was not of a short shock followed by adjustment. It was of sustained uncertainty that companies managed by building inventory in advance of tariff increases, by restructuring supply chains where possible, and by absorbing costs where not. All of these responses are economically inefficient. They represent resources devoted to managing tariff uncertainty rather than to productive investment. There is a specific dynamic in the 2025 trade war that distinguishes it from 2018 and makes its management considerably more difficult. The scale of the tariffs on China means that ordinary commercial relationships between American importers and Chinese manufacturers are no longer viable. A 145% tariff on Chinese goods does not produce a gradual reduction in Chinese imports. It produces a near total cessation of certain categories of trade. At 145%, a Chinese-made consumer electronic product that retailed for $100 now arrives at the border subject to $145 in tax. The final retail price, after the importer's costs and the retailer's margin, might be $350. There is no market for that product at that price because American alternatives that exist, and in many categories, American alternatives do not fully exist, are not 3 times as expensive as Chinese alternatives. The result is not that American manufacturers fill the gap. The result is that the category of product becomes scarcer and more expensive. Consumers buy less of it, importers who depended on it face severe pressure, and some portion of the supply chain shifts to third country producers in Vietnam, Indonesia, or elsewhere in Southeast Asia. China's response to a 145% tariff is not simply to accept lower exports. It is to accelerate the diversification of its export destinations, to sell more goods to Europe, Southeast Asia, Africa, and Latin America, and to manage the domestic economic impact of reduced American sales through fiscal stimulus and currency management. China has the institutional capacity to manage this adjustment in ways that the 2018-era analysis underestimated. What the escalation to 145% tariffs does is essentially decouple the American and Chinese economies in the categories it covers. This decoupling produces economic pain on both sides, but it produces more disruption in supply chains on the American side, where the dependency on Chinese manufacturing is more complete and the alternatives are less developed than on the Chinese side. The Federal Reserve is now navigating a situation with no good options. Tariffs are inflationary by definition. They raise the price of imported goods. Higher prices for imported goods raise the measured rate of inflation. The Federal Reserve's mandate is to maintain price stability, to keep inflation near its 2% target. When tariffs push inflation above target, the standard monetary policy response is to raise interest rates. But the same tariff shock that produces inflation also produces a slowdown in economic activity. Higher costs for businesses, lower volumes of trade, supply chain disruption, reduced investment, all of these are deflationary forces. If the Federal Reserve raises interest rates to combat tariff-driven inflation, it risks deepening the economic slowdown. If it keeps rates low to support the economy, it risks allowing inflation to become entrenched. This is stagflation risk, the combination of rising prices and slowing growth that is the most difficult macroeconomic environment for a central bank to manage. The United States has not experienced sustained stagflation since the 1970s, and the policy tools available to address it have not been tested against a tariff-driven supply shock of this scale in the modern era. The 1970s experience is instructive. The oil price shocks of 1973 and 1979 produced stagflation that the Federal Reserve under Arthur Burns initially accommodated, allowing inflation to run higher rather than choking off growth. The result was inflation that became entrenched in expectations, requiring the brutal recession of 1981 and 1982 under Paul Volcker to finally suppress. The lesson was, do not allow a supply shock to become embedded in wage price inflation. If the Federal Reserve applies that lesson now, raising rates aggressively to prevent tariff-driven inflation from becoming entrenched, it risks a significant recession. If it prioritizes employment and accepts higher inflation, as it did in the early 1970s, it risks the entrenching of an inflation cycle that will require even more painful correction later. There is no clean solution. The tariffs have created a situation in which the Federal Reserve must choose between bad options, and the historical record suggests that either choice has significant costs. The international monetary and financial consequences of the 2025 trade war are less discussed than the domestic price and employment effects, but are potentially more durable. The United States dollar is the world's reserve currency. This status, the fact that international trade, international financial transactions, and central bank reserves around the world are predominantly denominated in dollars, provides the United States with what Charles de Gaulle called the exorbitant privilege: the ability to borrow at lower interest rates, to run trade deficits without the currency constraints that other countries face, and to use the dollar as a tool of geopolitical leverage. That privilege is not guaranteed. It is sustained by the confidence of other countries in the stability, reliability, and rule of law credentials of the United States as an economic and financial power. When the United States imposes tariffs unilaterally, in violation of World Trade Organization rules on allies and adversaries alike, and does so with abrupt and unpredictable changes that make long-term commercial planning impossible, it signals to the world that the United States is not a reliable economic partner. The diversification away from dollar dependency that China, Russia, and other countries have been pursuing for years, through bilateral trade agreements in non-dollar currencies, through the development of alternative payment systems, through the reduction of dollar-denominated reserves, receives an accelerant from trade war uncertainty. The dollar's reserve currency status is not at immediate risk of dramatic collapse. But the erosion is real, it is measurable in the data, and it is a cost that the trade war inflicts on American financial power in ways that do not appear in the Consumer Price Index. What does the historical record say about how trade wars end? The answer from every major historical episode is the same. They end when the political pain of the war outweighs the political benefit of the protectionist narrative. This is not an economic equilibrium, it is a political one. Smoot-Hawley was partially reversed by the Reciprocal Trade Agreements Act of 1934, which gave the executive branch the authority to negotiate bilateral reductions in tariff rates. The process of rebuilding global trade after the Depression and the Second World War took decades and produced the framework. The General Agreement on Tariffs and Trade, eventually the World Trade Organization, that governed global commerce until the current period. The 2018 trade war ended, partially, with the Phase 1 deal of January 2020. It was followed by a pandemic that dramatically changed the economic context and obscured the effects of the tariffs in the noise of a global economic shock of a completely different kind. The 2025 escalation shows no clear signs of imminent negotiated resolution. The tariff levels, particularly on China, are high enough to make negotiation difficult. The political dynamic in which tariffs are presented as an assertion of strength and any reduction would be presented as a capitulation, makes it difficult for either side to retreat without significant domestic political cost. The most likely trajectory, based on historical precedent, is a prolonged period of elevated tariffs, sustained disruption to supply chains, elevated consumer prices, and periodic negotiation that produces partial and unstable agreements. Not a clean reversal. Not a decisive victory for the protectionist position. A grinding, economically costly standoff that ends not through a dramatic resolution, but through the slow accumulation of enough domestic economic pain to change the political calculation. For individuals trying to navigate their own financial decisions in this environment, the historical record offers a few observations that are more useful than most of the daily commentary. First, supply chain disruptions and tariff-driven price increases are real but not permanent. The inflationary effect of tariffs is a one-time price level shift, not a permanent acceleration of inflation. Prices may be higher, but they do not keep rising at tariff rates indefinitely. This suggests that businesses and households that can absorb short-term cost increases without forced asset sales are better positioned than those who are leveraged against a continuation of pre-tariff price levels. Second, the sectors most exposed to tariff risk are identifiable. Companies with heavy dependencies on Chinese manufacturing or on export sales to countries imposing retaliatory tariffs face more direct earnings pressure than companies with domestic supply chains and domestic customers. This is not investment advice. It is the kind of sectoral analysis that the historical record of tariff impacts supports. Third, the historical record of trade wars does not support the prediction of catastrophic, permanent economic damage. The Great Depression was caused not by Smoot-Hawley, but by the Federal Reserve's monetary policy failures and the gold standard constraint. Trade wars are economically costly and economically stupid, but they are survivable. The economies that lived through them, including the American economy in the 1930s, eventually recovered. The recovery was slower and more painful than it needed to be. But it happened. What the historical record does not support is the claim that tariffs at the scale now being implemented will produce the manufacturing renaissance that their proponents promise. The factories did not come back in 2018. They will not come back in 2026 any faster because the economic fundamentals that moved manufacturing to China — cost, infrastructure, supply chain depth, skilled workforce — have not changed. They may change over decades. They will not change in response to a tariff announcement. The history of every major tariff war in the modern era is a history of the same lesson being learned at great economic cost, repeatedly, that the price of imports is not the primary determinant of where manufacturing locates. The story of the 2025 trade war, read through that history, is still being written. But the pattern is familiar. This is what trade wars actually do. And this is where the record says we are heading.